On March 15, 2023, an event occurred that should have dominated headlines worldwide, yet it largely went unnoticed by Americans. Saudi Arabia declared its willingness to accept Chinese yuan for oil sales to China, a departure from the long-standing dollar hegemony. This marked the first time in nearly half a century that the world's leading oil exporter agreed to transact in a currency other than the US dollar for its most crucial commodity. The petrodollar monopoly, which had been in place since 1974, was effectively breached. This was more than just a routine trade agreement. It represented stage 6 of an 8-stage pattern of collapse that has historically afflicted every reserve currency. The Portuguese real faltered in the 1600s, the Dutch guilder in the 1700s, and the British pound in the 1900s. Now, the US dollar appears to be following a similar trajectory, experiencing the same stages and encountering parallel crises. We are currently entering a particularly precarious phase, characterized by the rise of alternative currencies that are gaining momentum, leading to an exponential acceleration of the dollar's decline. It's crucial to recognize that reserve currency status is not immutable. It operates in cycles lasting roughly 80 to 110 years. The cycle involves a currency's ascent, dominance, overextension, the emergence of competitors, erosion of confidence, adoption of alternatives, accelerated crisis, and eventual replacement. This pattern has unfolded 3 times in the past 500 years, and each time, the dominant power stubbornly refused to acknowledge the possibility of its currency's decline, believing itself to be immune. They were mistaken. The dollar is currently in stage 6 of 8, with alternatives gaining traction. The petrodollar system is showing signs of strain, and BRICS nations are constructing parallel financial systems. Based on historical precedents, the dollar has approximately 10 to 15 years before it completely loses its reserve status. This doesn't mean the dollar will vanish entirely, but it will no longer be the dominant currency. The implications are profound. America's capacity to print money and export inflation will cease. The national debt, currently at $36 trillion, will become unsustainable. Interest rates will skyrocket, and living standards could plummet by 30 to 40%. This is arguably the most significant economic narrative of our time, yet it's largely being ignored. I want to illustrate the precise 8-stage pattern that led to the downfall of 3 previous reserve currencies, pinpoint the dollar's current position within that pattern, identify the specific mechanisms accelerating its decline, explain why the petrodollar's demise is unique and faster than previous transitions, highlight who stands to gain and who will suffer, and provide a timeline based on historical data. This analysis isn't mere speculation. It's rooted in pattern recognition, and the pattern is clearly signaling the end of the dollar's dominance. Before we delve into the 8-stage pattern, it's essential to understand the true nature of a reserve currency and its significance. A reserve currency is the primary foreign exchange reserve held by countries worldwide. Central banks accumulate these reserves to facilitate international trade, settle debts, and stabilize their own currencies. When a currency attains reserve status, it provides significant advantages to the issuing country. First, it creates structural demand. If countries universally need dollars for international commerce, they are compelled to continuously purchase them. This generates consistent demand irrespective of the underlying health of the economy. Second, it confers seigniorage benefits. The issuing country can print money and exchange it for tangible goods from other nations. They offer paper, and in return, receive cars, electronics, and oil, an extraordinary privilege. Third, it enables cheap borrowing. Because of global demand for the currency, governments can issue bonds at lower interest rates than economic conditions might otherwise dictate. Fourth, it allows for exported inflation. When money is printed, inflation is distributed globally as the currency is held worldwide, effectively transferring the inflation burden to others. These 4 advantages collectively make reserve currency status the ultimate economic tool. However, losing this status can be catastrophic. When the currency is no longer essential for trade, demand collapses. The government loses its ability to borrow cheaply, and printing money leads to immediate domestic inflation. Living standards, which have been artificially inflated for decades through seigniorage, revert to what the domestic economy can actually support. This is precisely what happened to Portugal, the Netherlands, and Britain, and it's now beginning to unfold in America. Let's examine the 8-stage pattern. This model accurately describes the collapse of all three previous reserve currencies, and it is currently playing out with the dollar. Stage 1 involves dominance established through economic and military superiority. A currency achieves reserve currency status when the issuing country is the preeminent economic and military power. This builds trust as the world believes in the stability and strength of the country and its currency. In the 1500s, Portugal controlled the spice trade. Its ships dominated the sea routes around Africa to India and the East Indies. Spices like pepper, cinnamon, and cloves were more valuable than gold. Portugal maintained control through military dominance at sea and strategic ports like Goa, Malacca, and Macau. The Portuguese real became the currency of Asian trade, essential for merchants buying spices, making it the reserve currency of the Indian Ocean trade. The Dutch Republic in the 1600s possessed the most efficient economy in Europe. Amsterdam was the world's trading hub. The Dutch East India Company, VOC, was the wealthiest corporation ever, worth $7.9 trillion in today's money. Dutch ships controlled trade in the Baltic, Asia, and the New World. The guilder became the reserve currency because Dutch financial markets were the most sophisticated. The Amsterdam Stock Exchange, founded in 1602, was the world's first. The Bank of Amsterdam, established in 1609, was the most trusted bank globally. The guilder was widely held due to the safety and liquidity of Dutch finance. After defeating Napoleon in 1815, Britain became the global superpower. The Royal Navy dominated the seas, and British industry led manufacturing. The British Empire encompassed a quarter of the world's land and population. The pound became the reserve currency due to Britain's control over global trade. The gold standard, adopted by Britain, meant the pound was convertible to gold at fixed rates, making it as good as gold. By 1900, 60% of international trade was invoiced in pounds. After World War II, America accounted for 50% of global GDP. The U.S. military was unrivaled. The Bretton Woods Agreement in 1944 designated the dollar as the official reserve currency, convertible to gold at $35 per ounce. Other currencies were pegged to the dollar, making it equivalent to gold, as America held the majority of the world's gold reserves. Even after Nixon ended gold convertibility in 1971, the dollar maintained its dominance through military strength and the 1974 Petrodollar agreement with Saudi Arabia. Stage 1 establishes dominance, but dominance inevitably contains the seeds of its own decline. Stage 2 is peak power and overextension. At the zenith of its power, the dominant country overextends itself by engaging in unaffordable wars, excessive borrowing, and printing money to finance imperial ambitions. The currency remains strong due to inertia, with continued global demand, but the underlying fundamentals weaken. Portugal, at its peak, controlled the entire Indian Ocean spice trade but overextended itself. It tried to maintain a military presence in numerous ports from Mozambique to Macau. Its small population, only 1 million in Portugal, couldn't sustain a global empire. Wars with rival European powers depleted resources. Portugal borrowed heavily from Italian and German bankers. By 1560, debt service consumed 60% of royal revenues. The real remained strong due to the spice monopoly, but the empire was unsustainable. The Dutch, at their peak, controlled global shipping. However, they fought 3 wars with England between 1652 and 1674 and multiple wars with France. Military spending soared. The Dutch economy, based on trade and finance, couldn't sustain large-scale land wars. The Dutch East India Company, though still profitable, faced increasing competition from the English East India Company. By 1700, the Dutch spent more on defense than they earned from trade, leading to accumulating debt. However, The guilder remained the reserve currency due to Amsterdam's robust financial infrastructure. At its peak in 1870, Britain controlled the largest empire in history, but by 1900, competitors emerged. Germany industrialized rapidly, and America's economy surpassed Britain's by 1890. Britain fought the Boer War from 1899 to 1902, costing $200 million, or 10% of annual GDP. It maintained the world's largest navy at enormous expense. The pound remained dominant, but Britain borrowed to sustain the empire. By 1914, Britain was a net debtor to America. America, at its peak in 1950, had no rivals. But the Vietnam War, from 1964 to 1975, cost $168 billion, forcing Nixon to end gold convertibility in 1971. Military spending continued with the Cold War, Gulf Wars, Iraq, and Afghanistan. By 2008, U.S. debt was $10 trillion. However, the dollar remained the reserve currency due to the lack of alternatives. The petrodollar system, established in 1974, mandated that oil could only be purchased in dollars, creating structural demand. Stage 2 is characterized by overextension while maintaining currency dominance through inertia. Stage 3 is when competitors emerge and build alternative systems. Other countries, observing the dominant power overextend itself and abuse its privileges, start creating alternatives, not to immediately replace the reserve currency, but to reduce vulnerability. Spain, England, and the Dutch all established rival trading companies to compete with Portugal. The English East India Company, founded in 1600, and the Dutch East India Company, founded in 1602, competed with Portugal for Asian trade. These rivals offered better ships, financing, and more efficient trade networks, cracking Portugal's monopoly. By 1620, the Dutch controlled most of the spice trade. The real was still used, but alternatives existed. Britain built financial infrastructure to compete with Amsterdam. The Bank of England, founded in 1694, provided stability, and London's financial markets grew. France, under Louis XIV, attempted to create alternative financial centers. The Dutch guilder remained dominant, but London was rising. By 1750, British trade volume exceeded Dutch trade. The guilder remained the reserve currency, but Britain's pound was gaining ground. America emerged as Britain's rival. World War I devastated British finances, and Britain borrowed $1.2 billion from America to finance the war. After World War I, Britain was deeply in debt to America, and America's economy surpassed Britain's. The Federal Reserve, created in 1913, provided alternative financial infrastructure, and New York competed with London. The pound remained the reserve currency, but the dollar was on the rise. The 2008 financial crisis exposed the dollar system's fragility, prompting China, Russia, and other nations to develop alternatives. China created CIPS, Cross-Border Interbank Payment System, in 2015 to rival SWIFT, while Russia created SBFS, System for Transfer of Financial Messages, its own payment system. BRICS nations discussed creating a common currency. These systems weren't designed to immediately replace the dollar, but to offer alternatives if America weaponized it. Stage 3 is when alternatives are built defensively. Stage 4 involves currency weaponization accelerating alternative adoption. The dominant power, facing challenges, resorts to using its currency as a weapon. Sanctions, asset freezes, and exclusion from payment systems are employed. However, this tactic backfires, as targeted countries accelerate the development of alternatives, and neutral countries, recognizing their vulnerability, hedge by diversifying away from the dominant currency. A weakening Portugal attempted to exclude rival traders from its ports, seizing Dutch and English ships in Asian ports. This forced rivals to build their own port networks. The Dutch established Batavia, Jakarta, as an alternative trading hub, and England built Fort St. George in Madras. Portugal's weaponization of trade access accelerated rival systems. By 1600, Portugal couldn't exclude competitors because they had built parallel infrastructure. During its war with France, Britain blockaded Dutch ports during the Fourth Anglo-Dutch War, 1780 to 1784, causing Dutch trade to collapse and the guilder to lose value. Dutch merchants, unable to use traditional routes, began using London banks instead of Amsterdam. Britain's weaponization of sea power destroyed Dutch dominance, ending Amsterdam's role as a financial capital, which was replaced by London. During World War I, Britain froze German assets in London through the Trading with the Enemy Act of 1914. This demonstrated that British banks weren't safe during conflict. After World War I, neutral countries reduced pound holdings, fearing Britain would freeze assets again. The Great Depression in 1931 forced Britain off the gold standard, devaluing the pound by 30%, leading to an evaporation of trust and countries diversifying reserves into dollars and gold. Britain's weaponization of finance during World War I accelerated the pound's decline. America's weaponization of the dollar has accelerated dramatically in two phases. First, the 2014 sanctions on Russia after the Crimea annexation, which excluded Russia from some dollar transactions. Russia responded by reducing dollar reserves from $130 billion in 2013 to near zero by 2020, and increasing gold reserves from 1,000 tons to 2,300 tons. Russia also developed the SPFS payment system. Second, the 2022 sanctions after the Ukraine invasion, where America froze $300 billion in Russian central bank reserves and cut Russia off from SWIFT. This was the nuclear option, and it backfired catastrophically. Every country watching realized that dollar reserves can be frozen, SWIFT access can be revoked, and wealth isn't safe if America considers you an enemy. The result was mass de-dollarization. China reduced U.S. Treasury holdings from $1.3 trillion in 2013 to $775 billion in 2024. Saudi Arabia diversified reserves, reducing the dollar share from 90% to 70%. Central banks globally bought 3,100 tons of gold in 3 years, 2022 to 2024, the highest since the 1970s. Countries built alternative payment systems. The weaponization intended to punish Russia instead convinced the entire non-Western world to build alternatives to dollar dependence. Stage 4 is when weaponization accelerates de-dollarization. Stage 5 is when confidence cracks and reserve share begins falling. After weaponization demonstrates vulnerability, countries actively reduce holdings of the dominant currency, leading to a decline in reserve share from its peak. This stage can last 10 to 30 years, but it's irreversible once started. After Dutch and English alternatives emerged, merchants reduced their real holdings. By 1640, the real represented less than 20% of Asian trade currency, down from 60% in 1580. The decline took 40 years, but once it started, it accelerated. After British blockades damaged Dutch trade, the guilder's reserve share fell. In 1780, the guilder represented 40% of European reserves, but by 1815, it was less than 10%. The Napoleonic Wars destroyed what remained of Dutch financial dominance. Amsterdam was occupied by France, and Dutch trade collapsed. The guilder declined from 40% to irrelevance in 35 years. World War I destroyed British finances. Britain borrowed heavily from America. After World War I, the pound was weakened, and its share of reserves fell from 60% in 1913 to 50% in 1930, and then to 30% in 1940. Bretton Woods in 1944 formalized the dollar's replacement of the pound. The pound declined from dominance to secondary status in 30 years. The dollar's reserve share peaked at 71% in 1999. By 2024, it's 58%. That's a 13 percentage point drop in 25 years. Not fast, but consistent and accelerating. The last 2 years saw a 4 percentage point drop. At this rate, the dollar falls below 50% by 2030 and below 40% by 2035. This is stage 5, where the decline is visible, irreversible, and accelerating. Stage 6 is when alternatives gain critical mass and network effects flip, marking a danger zone. Alternative systems reach a tipping point where using them becomes easier than using the dominant currency. Network effects, which previously favored the dominant currency, now shift. Merchants prefer alternatives because customers prefer alternatives, leading to an accelerating spiral. By 1640, Dutch and English trade networks were more extensive than Portuguese ones. Merchants preferred Dutch guilders because they could trade in more ports, access better financing, and ship on more reliable fleets. The real was still used in Portuguese colonies, but global trade shifted to guilders. Once the network effect flipped, the real's decline was rapid. After Napoleon, Amsterdam never recovered its financial dominance. London's financial markets were larger, more liquid, and backed by a stronger military. The Bank of England was more trusted than the Bank of Amsterdam. Merchants preferred pounds because London offered better credit, insurance, and shipping. The guilder became a regional currency, while the pound became global. World War II destroyed Britain's economy, and Britain borrowed $30 billion from America. After the war, Britain was bankrupt. The 1956 Suez Crisis demonstrated that Britain couldn't act without American approval. America threatened to crash the pound if Britain didn't withdraw from Suez, and Britain complied. From that moment, everyone knew the pound was subordinate to the dollar. The network effect had flipped, and merchants preferred dollars because America was more powerful. We are entering stage 6 right now. March 2023 saw Saudi Arabia accept yuan for oil, breaking the petrodollar monopoly. December 2024 saw Saudi Arabia join BRICS, signaling diversification away from exclusive U.S. alignment. China's CIPS payment system processed $27 trillion in 2023, up from $12 trillion in 2020, more than doubling in 3 years. BRICS announced plans for a common currency backed by gold and commodities. Brazil and Argentina are negotiating bilateral trade in local currencies, bypassing dollars. India and Russia trade in rupees and rubles. The UAE accepts yuan for oil from China. The alternatives are gaining critical mass. Here's the key metric. In 2022, 73% of international trade was invoiced in dollars. By 2024, it's 58%. That's a 15 percentage point drop in 2 years. This is the network effect flipping. Merchants are choosing non-dollar currencies because their trading partners accept non-dollar currencies. The spiral is starting. Stage 7 is crisis acceleration and panic diversification. Once the network effect flips, a crisis accelerates the collapse. War, financial crisis, or policy mistake triggers panic. Countries dump reserves, and the currency crashes. The dominant power tries to stop the fall, but it's too late. The alternatives are too strong. The War of Spanish Succession, 1701 to 1714, destroyed what remained of Portuguese trade. Portugal sided with Britain, and France blockaded Portuguese ports. Portuguese trade in Asia collapsed entirely. By 1720, the real was worthless outside Portugal. Napoleon's continental system, 1806 to 1814, blocked British trade with Europe, but it also destroyed Dutch trade. Amsterdam, occupied by France, was cut off from its colonies. The guilder crashed. After Napoleon's defeat, the guilder never recovered, becoming a minor currency. World War II was the crisis for Britain. Britain spent everything fighting Germany. By 1945, Britain owed $30 billion, 3 times its GDP. Britain was bankrupt. The pound was devalued 30% in 1949. India gained independence in 1947, ending the jewel of the empire. The Suez Crisis in 1956 was the final humiliation. The pound collapsed from global reserve to regional currency in 15 years. The crisis for the dollar is coming. It could be triggered by multiple factors. First, a BRICS currency launch. If BRICS successfully launches a gold-backed currency for international trade, it creates a credible alternative. Oil producers might accept it, breaking dollar demand. Second, a U.S. debt crisis. Federal debt is $36 trillion, and interest payments are $1.2 trillion annually. If bond markets lose confidence, yields spike. The Fed must print money to buy bonds, leading to surging inflation and a dollar crash. Third, military overextension. If America is simultaneously committed to multiple conflicts, Taiwan, Ukraine, Middle East, and can't win decisively, its credibility collapses. Fourth, commercial real estate defaults causing a banking crisis. If 500 to 1,000 regional banks fail due to commercial real estate, confidence in the U.S. financial system breaks. Any of these could trigger Stage 7, crisis acceleration and panic diversification. Countries dump treasuries, and the dollar falls 30 to 50% against other currencies in months. This forces the Fed to raise rates dramatically to attract capital, causing a recession, or print money dramatically to buy treasuries, causing inflation. There's no good option. Stage 7 is the collapse. Stage 8 is replacement, and a new dominant currency emerges. After the crisis, a new reserve currency emerges, not immediately, but over 5 to 10 years. One currency becomes the new standard. The old currency still exists, but it's no longer dominant. The guilder replaced the real gradually. By 1680, most international trade used guilders. The real remained Portugal's domestic currency, but it was globally irrelevant. The pound replaced the guilder gradually. By 1815, most international trade used pounds. The guilder remained the Netherlands' currency, but it was no longer global. Bretton Woods in 1944 made the dollar the official reserve currency, but the transition took 15 years. In 1950, the pound was still widely used. By 1960, the dollar was clearly dominant. By 1970, the pound was secondary. The replacement for the dollar isn't clear yet. 3 possibilities exist. First, the Chinese yuan. If China's economy continues growing and CIPS becomes the dominant payment system, the yuan could replace the dollar. But the yuan has problems, including capital controls, lack of transparency, and an authoritarian government that could freeze assets. Second, a multipolar system where the euro, yuan, and dollar all coexist as regional reserve currencies, with no single dominant currency. Third, gold, or a gold-backed currency. If the BRICS currency is genuinely backed by gold and commodities, it could become a neutral reserve alternative. The replacement will be determined by which system offers the most stability, liquidity, and trust. Now let me show you why the petrodollar's death is different and faster than previous transitions. Previous reserve currency transitions took 30 to 50 years from peak to replacement. The dollar's transition will be faster, estimated at 20 to 30 years from its peak in 2000 to replacement between 2030 and 2050. Why? First, technology accelerates everything. In 1914, moving gold reserves between countries took weeks, involving ships, railroads, and physical transport. Today, moving billions in reserves takes seconds through digital transactions. This means de-dollarization can happen much faster, with countries able to dump treasuries and buy yuan or gold in minutes. Previous transitions were slow because logistics were slow, but this transition will be fast because digital finance is instant. Second, alternatives already exist. In 1940, when the pound was failing, there was only one alternative, the dollar. America was the only economy large enough to be a reserve currency. Today, there are multiple alternatives, including the yuan, the euro, gold, a BRICS currency, and cryptocurrency. This means countries can diversify immediately without needing to wait for an alternative to be built. The alternatives are ready. Third, the petrodollar was artificial. The Portuguese real, Dutch guilder, and British pound were backed by real economic dominance, trade, manufacturing, and financial sophistication. The petrodollar, since 1974, has been backed by an agreement with Saudi Arabia mandating oil sales only in dollars. But that agreement was political, not economic. Once the political relationship weakens, the petrodollar ends instantly, and that weakening is happening now. Saudi Arabia is diversifying relationships, accepting yuan, and joining BRICS. The petrodollar was always vulnerable because it was based on a single bilateral agreement, and that agreement is ending. Fourth, America is more indebted than previous reserve powers. Portugal, the Netherlands, and Britain had debt problems, but nothing like America's $36 trillion, or 120% of GDP. When the dollar loses reserve status, America can't finance deficits, leading to spiking interest rates, austerity, or hyperinflation. Previous transitions were slow partly because the declining power could manage the decline gradually. America can't. The debt forces rapid adjustment. Fifth, globalization means faster contagion. In 1940, if Britain had a currency crisis, it affected the empire and some trade partners. Today, if America has a currency crisis, it affects the entire global economy instantly. There's $80 trillion in dollar-denominated debt globally, $21 trillion in U.S. money supply, and $13 trillion in U.S. treasuries held by foreigners. If confidence breaks, the selling pressure is immediate and global. Previous transitions were regional, but this transition is global, making it faster and more chaotic. Now let me show you the timeline based on where we are in the pattern. 2000 to 2008 was peak dollar dominance, with a 71% reserve share, an unchallenged petrodollar, and America's military dominance after its Cold War victory. This was stage 2, peak power. 2008 to 2014 saw the financial crisis damage confidence. China began building CIPS, and countries questioned dollar safety, but no alternatives existed yet. This was stage 3, with competitors building alternatives. 2014 to 2022 saw Russia sanctions in 2014 and COVID money printing in 2020 accelerate concern. Russia de-dollarizes, and China expands CIPS, but the system still holds. This was stage 4, where currency weaponization begins. 2022 to 2023 brought the Russia SWIFT cutoff and the $300 billion reserve freeze. This is the watershed moment. Every country now understands that their dollar reserves are susceptible to seizure. This realization is triggering a widespread move away from the dollar, known as de-dollarization. In March 2023, Saudi Arabia's acceptance of a currency other than the dollar for oil payments to China, specifically the yuan, marked a significant break in the petrodollar monopoly. This event signals the transition from stage 4 to stage 5 of the dollar's decline. From 2023 to 2025, we'll likely see the dollar's share of global reserves fall from 60% to around 58%, while its share of global trade drops from 73% to approximately 58%. Central banks are responding by purchasing over 1,000 tons of gold annually. The BRICS Economic Alliance is expanding to include 9 members, and the volume of transactions through China's cross-border interbank payment system, CIPS, is doubling. This represents stage 5, where confidence in the dollar starts to crack, paving the way for stage 6. Alternative currencies are gaining momentum and wider acceptance. The period from 2025 to 2030 will likely see the launch of a BRICS currency, projected for 2026 or 2027. More nations will accept non-dollar payments for oil, further eroding the dollar's dominance. As a result, the dollar's share of global reserves and trade will fall below 50%. The network effects of using the dollar will begin to flip. It will become easier and more advantageous to use alternative currencies than the dollar. This marks the arrival of stage 6, signifying that the critical mass for alternatives has been reached. From 2030 to 2035, a crisis is likely to trigger widespread panic. Potential triggers include the success of a BRICS currency, a U.S. debt crisis, military overextension, a banking crisis, or a significant dollar crash, 30 to 50%. The Federal Reserve will then be forced to choose between printing more money, which leads to inflation, or raising interest rates, which could trigger a depression. This phase signifies stage 7, a period of accelerated crisis. Between 2035 and 2050, a new system will emerge. It could involve renewed dollar dominance, a multipolar currency system, or a gold-backed BRICS currency becoming the primary global reserve. The dollar will remain a major currency, but it will no longer be the sole reserve currency. This represents stage 8, the replacement phase. This timeline is based on observed historical patterns. This process could accelerate if a major crisis occurs sooner or slow down if the United States successfully defends the dollar's dominance. However, the overall direction is set. The dollar's influence is declining, and that decline is accelerating. Now, let's examine the winners and losers in this shift. Gold holders stand to gain significantly. Historically, when reserve currencies collapse, the price of gold surges. During the decline of the British pound from 1940 to 1960, gold went from $35 per ounce, the official price, to $850 per ounce by 1980, a 24-fold increase when it was fully floated. Similarly, when the dollar's gold convertibility ended in 1971, gold rose from $35 to $800 by 1980, a 23-fold increase. The BRICS nations, including China, Russia, India, Brazil, South Africa, and new members like Saudi Arabia, the UAE, and Iran, will also benefit. These countries gain economic independence from the U.S.-controlled financial system, enabling them to trade in their own currencies, hold reserves, diversify assets, and avoid sanctions. Their geopolitical power increases as U.S. influence declines. Commodity exporters also stand to win. If oil, gas, metals, and food can be sold in multiple currencies instead of solely in dollars, exporters gain leverage. They can demand better prices and choose currencies that maintain their value. Saudi Arabia's acceptance of the yuan gives them negotiating power, reducing their dependence on the dollar system. Countries with low debt levels also benefit, including Switzerland, Norway, Singapore, and Germany. These countries, with strong economies and low debt, can attract capital fleeing the dollar, strengthening their currencies and becoming safe havens. The United States stands to lose the most. For the past 50 years, America's economic model has relied on printing dollars to buy real goods from other countries, maintaining a standard of living above what the economy actually produces. This is the exorbitant privilege afforded by being the reserve currency. When that privilege ends, American living standards will fall. The trade deficit, currently at $800 billion annually, will become unsustainable. America will need to export more or import less, which translates to fewer goods, higher prices, and lower consumption. Estimates suggest a 20 to 30% decline in living standards over 10 to 15 years as the dollar's privilege diminishes. Dollar savers and bondholders will also lose out. If you hold dollars, treasuries, or dollar bank accounts, your purchasing power will erode. A dollar devaluation of 30 to 50% means your wealth loses 30 to 50% of its international purchasing power. A $1 million treasury portfolio could be worth only $500,000 to $700,000 in real terms. Domestic inflation might be contained if the U.S. government controls prices. However, global purchasing power will collapse. Countries with dollar-denominated debt are also at risk. Developing nations owe $13 trillion in dollar debt. If the dollar strengthens temporarily before collapsing, as creditors demand higher rates, this debt becomes more expensive to service. Conversely, if the dollar collapses, these countries' dollar revenues from exports decline while their dollar debts remain fixed. Either way, dollar debt holders are squeezed. Wall Street and big banks will also face challenges. The U.S. financial industry's dominance is tied to the dollar's dominance. If international trade shifts to the yuan, euro, or BRICS currency, transactions will clear through Shanghai, Frankfurt, or Dubai instead of New York. Banking revenues will fall. Financial sector employment will decline, and New York's status as a financial capital will erode. The U.S. government will lose its ability to easily fund deficits. Currently, the U.S. borrows $2 trillion per year, with foreigners buying $1 trillion in treasuries to acquire dollar reserves. When foreigners no longer need dollar reserves, they will stop buying treasuries. Who then funds the deficit? The options are all unfavorable. The Fed prints money, causing inflation. The government cuts spending dramatically, which is politically impossible, or the government raises taxes dramatically, which is economically destructive. The wealth transfer from dollar holders to non-dollar asset holders will be the largest in history. Trillions will shift from America and dollar holders to BRICS nations, commodity producers, and gold holders. In conclusion, the 8-stage reserve currency collapse pattern has destroyed 3 currencies in the past 500 years: the Portuguese real, the Dutch guilder, and the British pound. Each time, the dominant power believed its currency was different, too important, and too big to fail. Each time, they were proven wrong. The decline took 30 to 50 years, but once it started, it was irreversible. The US dollar is currently in stage 6 of 8. Alternatives are gaining critical mass. The petrodollar monopoly established in 1974 was broken in 2023 when Saudi Arabia accepted the yuan. This was not just a trade deal. It signaled the beginning of a network effect shift. When the world's largest oil exporter sells in currencies other than dollars, it sends a clear message to every other country: you don't need dollars anymore. And once that message is sent, the downward spiral accelerates. Based on historical patterns and current acceleration, we have approximately 10 to 15 years before the dollar loses its reserve status. It won't be eliminated entirely, but it will no longer be dominant. The dollar's share will fall from 58% to 35 to 40%, while the trade share declines from 58% to 30 to 40%. This will usher in a multipolar currency world, where the euro holds 20 to 25%, the dollar 35 to 40%, and a gold-backed BRICS currency accounts for 15 to 20%. No single currency will dominate. And when that happens, America's 50-year free lunch will end. The ability to print money and buy real goods will cease. The $36 trillion debt will become unpayable, and living standards will fall. This is the cost of losing reserve currency status, a fate that Britain experienced from 1940 to 1970. America will experience it from 2025 to 2050. The pattern is clear, the stages are defined, and we are in stage 6. The collapse is accelerating, and no one can stop it because reserve currency dominance is not permanent. It's a cycle, and every cycle ends. The Portuguese real collapsed, the Dutch guilder collapsed, the British pound collapsed, and now the US dollar is collapsing. Not tomorrow, but inevitably, stage by stage, crisis by crisis, until a replacement emerges. If this documentary has revealed a pattern you were previously unaware of, and if you now understand that reserve currencies follow an 8-stage collapse cycle and the dollar is in stage 6, then subscribe, because over the next 10 years, I will track every stage of this collapse. Every BRICS development, every de-dollarization milestone, and every sign that stage 7 is approaching will be monitored. The petrodollar is dying, and the dollar's reserve status is ending. The 8-stage pattern is playing out exactly as it did 3 times before. History doesn't repeat itself, but it rhymes. And right now, it's rhyming with Portugal in 1640, the Netherlands in 1800, and Britain in 1945. The dollar's dominance is ending. The timeline is 10 to 15 years. Position yourself accordingly.